And today we're going to be talking about pin risk. What it is, how it could hurt you, and how understanding it can really help your options trading as well. Let's talk about YRCW. YRCW, you can see on the 8 strike, the open interest is 10,000. Now, for this example, I preferred that 10,000 to be on the 10 strike because YRCW is trading at 1060. So let's use our imagination and let's pretend those 10,000 open interest contracts are actually on the 10 strike. So I made a little Excel spreadsheet. YRCW $10, 10 strike, open interest 1,000, not 10,000, 1,000 in this example. Now the stock equivalent, if you're in the money of those 1,000 options contracts, is 100,000 shares of stock, okay? Because if you're long 1,000 calls on the 10 strike and YRCW expires at 11, you're long 100,000 shares at expiration if you didn't cover those options. So let's talk about pin risk and let me explain why it exists and how it works. Our position's long 1,000 of the 10 strike calls. There's 60 seconds to go before expiration on the third Friday in this example. The stock price is $9.80. So right now we're out of the money by 20 cents. The trader's position at expiration, if we close at 9.80, is nothing. These are out of the money. These are going to expire worthless. The delta is zero. The market's pricing in a zero probability of this stock ending up in the money. Next example. If we're long 1,000 of the 10 strike calls and there's 45 seconds to go before expiration, if the stock's price is at 10.10, at expiration, we're long 100,000 shares of stock. The delta's probably about 1. The market's pricing in 100% probability with 45 seconds in this example. What the trader needs to do is the trader needs to sell 100,000 shares, unless they want to be long 100,000 shares. If they sell 100,000 shares at 10.10 and they're long 1,000 from 10, they're going to lock in 10 cents. This example, long 1,000, 10 strike calls, 970. Trader's position at expiration is zero. But let's say they sold 100,000 here. The stock price went from 10.10, 10.05, 10, 9.90 because it knocked it down. Well, right here, the options are now worthless. But if we do a carryover from the previous example, you're short 100,000 shares. So you have to buy 100,000 shares. What's going to happen when you buy 100,000 shares of stock? 980, 990, 10, 1010. Oh no, 15 seconds to go until expiration. You're still long the 10 strike calls. You have no stock position because you shorted 100,000 and then you bought 100,000 back. So what do? At expiration, you'd be long 100,000. You need to sell 100,000 shares, 10, 10, 10. Now we pin. When you pin and the options expire at your strike price, here's something people don't know about options. We can trade these things until 4:15 Eastern time on Friday, right? But options actually expire 10 a.m. Eastern the next morning. So if it expires at 10 and you're long 1,000 of the 10 strike calls, you don't really know if you're going to get the stock or not get the stock because it expired directly on the strike. If it expired at 10:01, you're definitively long 100,000 shares because the rule is if you expire 1 cent in the money, the exchange is going to assume that you want to exercise your options. If it expired at 9.99, you're not going to have any position because the exchange is going to rightfully assume that you don't want to be long stock from 10 if it's trading at 9.99. That's how pin risk works, guys. How I manage pin risk? If you're in this kind of situation, and of course you're probably not going to be there with 1,000 options, but if you're there with 10 options, cover your position. Don't mess around with pin risk. It's a market maker's playground. They're playing all the games. Don't mess around. Cover your position. Don't deal with it. Hope that helps. My new members, I'm excited to see you in class on Friday. We'll continue this conversation. Jonathan, active day trader.